Chapter 14, Expectations, the Basic Tools. Learning Objectives. Understand the role of expectations in decision-making and hence economic fluctuations. Understand how monetary policy measures affect output, nominal interest rates, and real interest rates in the presence of expectations about inflation. Figure 14-1 defines the real interest rate as the return in terms of goods after 1 year. It shows the derivation of the real interest rate in the lower section. Equation 14.4 says the real interest rate is approximately equal to the nominal interest rate minus expected inflation. Figure 14-2 shows that nominal interest rates have declined considerably since the early 1980s, but because the expected inflation rate has declined as well, the real interest rate has declined much less. If we compare January 1981 and January 2006, we find that the nominal interest rate went down from 12.6% to 4.5%, whereas the real interest rate went up from 0.6% to 2.6% because inflation was 12% in 1981 and only 2% in 2006. Table 1 depicts why deflation can be very bad from 1929 to 1931 as nominal interest rate fell from 5.3% to 3.1%. Because of deflation, inflation rate went from 0% to negative 9.2%. Real interest rate thus went up from 5.3% to 12.3%, increasing the cost of borrowing and hurt the economy. Investors care about the real interest rate R. So in the IS relation shown in equation 14.5, we replace real interest rate R for nominal interest rate I. Investment spending and thus demand for goods depends on the real interest rate. LM relation is not affected because demand for money depends on opportunity cost of holding money, which continues to be I, the nominal interest rate. The opportunity cost of holding money is the nominal interest rate I, which is the return that could be earned on bonds and hence is given up by holding cash, which earns a zero rate of return. Figure 14-3 shows the equilibrium level of output and the equilibrium nominal interest rate are given by the intersection of the IS-LM curve at point A. The real interest rate equals the nominal interest rate minus expected inflation. Figure 14-4 shows that an increase in nominal money growth increases the real money stock given by M over P in the short run. This increase in real money leads to an increase in equilibrium output and decreases in both the equilibrium nominal and real interest rates since price level does not increase as much and expectations of inflation do not change in the short run. Figure 14-5 shows the adjustment of real and nominal interest rates to an increase in money growth. Suppose nominal money growth goes from 0 to 10% starting at time t. Before time t, both interest rates are constant and equal to each other. Inflation and expected inflation are equal to 0. An increase in money growth leads initially to decreases in both the real and nominal interest rates. Over time, however, the real interest rate returns to the initial value and the nominal interest rate rises to a new higher value equal to the initial value plus the increase in money growth. In the medium run, rate of inflation is equal to the rate of money growth. This result that in the medium run, the nominal interest rate increases 1-for-1 with inflation is known as the Fisher effect. Figure 1 plots the nominal interest rates and inflation numbers for 8 Latin American countries for 1992 and 1993, a period of high inflation for Latin America. Line with the slope of 1 reasonably fits the data. Real interest rate of 5% is assumed. Under the Fisher hypothesis, a 1% increase in inflation should be reflected in a 1% increase in the nominal interest rate, which seems to be reflected in the data points on the graph. Figure 14-6 shows the relationship between inflation rate and nominal interest rate in the US. Again, it is clear that over the medium run from 1960s to 1980s, interest rate and inflation rate moved together. During World War II, inflation was high but short-lived, so it was not reflected in higher nominal interest rates. Fisher effect is true for the medium run. Chapter 15, Financial Markets and Expectations. Learning objectives. Understand what the bond yield curve says about expected future short-term interest rates and economic activity. Understand how stock prices depend on current and expected future profits, as well as current and expected future interest rates. Effect of monetary policy and consumer spending on stock prices. Know that sometimes fads and bubbles cause stock prices to be unusually high. Figure 15-1 shows U.S. yield curves for November 1st, 2000 and June 1st, 2001. The yield curve, which was slightly downward sloping in November 2000, was sharply upward sloping 7 months later. Long-term interest rates, 30-year, was slightly lower at 5.8% than short-term interest rates, 3 months, at 6.2% on November 1st, 2000. On June 1st, 2001, 3-month interest rate was 3.5% and 30-year rate was 5.7%, giving us the sharply upward sloping yield curve. Equation 15.7 says that the 2-year interest rate is approximately equal to the average of the current 1-year interest rate and the next year's expected 1-year interest rate. In general, the yield or interest rate on a 10-year bond is equal to the average of the current 1-year interest rate and the 1-year interest rates expected for the next 9 years. General principle: long-term interest rates reflect current and future expected short-term interest rates. When the yield curve is upward sloping, this tells us that financial markets expect short-term interest rates to be higher in the future. When the yield curve is downward sloping, that is when long-term interest rates are lower than short-term interest rates, this tells us that financial markets expect short-term interest rates to be lower in the future. Figure 15-3 shows in November 2000, the U.S. economy was operating at point A with actual output being above the natural level of output. Businesses realized overinvestment in productive capacity. Investment was expected to go down. IS was expected to shift to the left, bringing output back to the natural level of output. Interest rates were expected to fall. This explains why the yield curve was slightly downward sloping in November 2000. Figure 15-4 shows what happened between November 2000 and June 2001 that caused the yield curve to be upward sloping in June 2001. Adverse shift in IS was larger than expected. Fed stepped in with expansionary monetary policy. Result: short-term interest rate became lower than expected. This explains why the 3-month interest rate on U.S. government bonds in June 2001 was so much lower than the 3-month interest rate on November 1st, 2000. Figure 15-5 shows the expected path of the U.S. economy as of June 2001. Investment spending was expected to rise. Tax cut of May 2001 was expected to increase consumption spending. This would shift IS curve to the right. In response, monetary policy was expected to tighten, causing LM to shift up. The short-term interest rate was expected to go up, making the yield curve upward sloping. In Figure 1, the yield curve shows that in July 2011, the economy was in a liquidity trap. Short-term interest rate was at 0 and it was expected to stay at 0 for the next 3 years. Figure 15-6 shows the sharp fluctuations in stock prices since the mid-1990s. So what determines stock prices? Figure 15-7 shows returns from holding 1-year bonds or stocks for 1 year. Equation 15.9 says that the price of the stock today must be equal to the present value of the expected dividend plus the present value of the expected stock price next year. On further substitutions and simplifications, the last term in equation 15.10 approaches zero. Further, the nominal variables can be replaced by real variables in the above equations to find that higher expected future real dividends lead to higher real stock price. Higher current and expected future 1-year real interest rates lead to a lower real stock price. Figure 15-8 studies the impact of expansionary monetary policy on stock prices. Expansionary monetary policy increases output in the short run and lowers the interest rate. If the Fed's move was anticipated, stock prices would have taken them into account, so they will not change after the move. If the move comes as a surprise, stock prices will go up. Figure 15-9 shows the effect of increase in consumption spending on the stock market. Panel A shows increase in consumption spending leads to higher output and higher interest rate. What happens to stock prices depends on slope of LM curve and on the Fed's behavior. Panel B shows flat LM leads to large increase in output and small increase in interest rate. Stock prices will go up. If LM is steep, output increases little, interest rates go up a lot. Stock prices will go down. Panel C shows if the Fed accommodates, output increases, but interest rate does not, stock prices go up. If Fed decides to keep output constant by restricting money supply, interest rates will go up and stock prices will go down. People in general need a higher return on stocks compared to bonds because of the higher risk that stocks impose. Equation 15.13 shows in that case the return on stocks has to be discounted by the interest rate plus the risk premium. Rational speculative bubbles form when price of a stock is higher than its fundamental value. Investors are willing to pay a high price for the stock in anticipation that they can sell it for an even higher price. One famous example of a rational speculative bubble is the tulip mania in 17th century Holland, discussed in the focus box in this chapter. Figure 1 shows the increase in U.S. housing price to rent ratio since 1985. Some economists argue that this represented a fad, an asset bubble, that is, increase in asset price based on what had happened in the past and not based on fundamental value of housing. It is believed that falling housing prices since 2006 caused the 2008 financial crisis. So it is good to remember that economic activity determines asset prices, but asset prices affect economic activity by influencing consumption and investment spending. These interactions among asset prices, expectations, and economic activity are the topics of the next two chapters. Chapter 16, Expectations, Consumption, and Investment. Having looked at the role of expectations in financial markets, we now see how expectations influence consumption and investment spending. Learning objectives. Explain how consumption decisions depend not only on a person's current disposable income, but also on the expected future income and financial wealth. Know how investment decisions depend on current and expected profits and on current and expected real interest rates. Explain why investment is more volatile than consumption. Milton Friedman in the 1950s presented the permanent income theory of consumption, and Franco Modigliani called his theory the life cycle hypothesis. Both said that the consumer considered more than current income in making consumption decisions. Equation 16.1 says consumption is a function of total wealth, which includes financial wealth and housing wealth, or non-human wealth, and human wealth, present value of expected after-tax labor income. Friedman and Modigliani suggested that the consumer plans for the entire lifetime and spends a constant fraction of the total wealth each year. Equation 16.2 states consumption depends on total wealth and more directly on current after-tax labor income. Expectations affect consumption spending directly through human wealth. To compute human wealth, consumers form expectations about future labor income, real interest rates, and taxes. Expectations affect consumption indirectly through non-human wealth by affecting prices of stocks, bonds, and housing. Two implications of the effect of expectations on consumption. 1. Consumption responds less than 1-for-1 to change in current income if these changes are seen as temporary. 2. Consumption may change even when current income does not change. Figure 16-1 shows expectations of change in family income were lowered at the start of each recession. The 2008 financial crisis was so severe that expectations stayed low even after the recession was over, and it continued to keep consumption spending low. Equation 16.3 shows the present value of expected profits of an investment depends on the expected profits and the expected real interest rates and the depreciation rate. Figure 16-2 shows how the present value of expected profits is calculated. In year 2, the machine depreciates by delta. Expected profit in year 2 is calculated by adjusting for depreciation of the machine. Equation 16.4 says investment is a positive function of the present value of expected profits that can be generated by an investment. Equation 16.5 says present value of expected profits depends positively on profit rate per unit of capital and negatively on the sum of the real interest rate and the depreciation rate. Figure 1 shows tight relation between Tobin's Q, ratio of a machine's capital value to purchase price, and ratio of investment to capital. Tobin said that investment and stock prices should move together since they both depend on the discounted value of future profits. Equation 16.6 shows a special case where the relation among investment, profit, and interest rate becomes very simple. The sum of real interest rate and delta in the denominator measures the user cost of capital or the rental cost of capital. Under the simplifying assumption that firms expect profits and interest rates to be the same in the future as they are today, we can think of investment as depending on the ratio of profit to the user cost of capital. Equation 16.7 says that investment in reality depends on current and expected future profits per unit of capital. Equation 16.8 says that profit per unit of capital depends positively on output per unit of capital or current sales per unit of capital. Figure 16-3 shows changes in investment and changes in profit move together. Figure 16-4 shows that profit per unit of capital and output per unit of capital move together. Figure 16-5 shows investment is more volatile than consumption. Conclusion: however, since investment accounts for only 15% of GDP, whereas consumption accounts for 70%, movements in investment and consumption contribute roughly equally to fluctuations in output over time.